Assalamualaikum and welcome to the latest episode of Wahed Wealth Digest. My name is Kamal Mustadza, and in today's episode, we break down the key economic events that took place in the global markets and how this would impact you as an investor. So let's get started. Historically, September is generally the worst month for the markets, and last month wasn't any different. Global markets took a hit last month as familiar concerns about inflation and higher interest rates persisted. To put into context, the MSCI World Economic Index dropped by 3.3% in September, while the Dow Jones Sukuk Index fell by 1%. So what actually happened? The big story in September was the rise in market interest rates as measured by bond yields. As we mentioned previously, the yield curve is currently inverted, with short-term yields being much higher than the longer-term yields. This shape of the yield curve suggested expectations of a short period of high interest rate, followed by a longer-term period of lower interest rates, reflecting investors' expectation for a decline in longer-term interest rates in an effort to stimulate economic activity. So in September, what we saw was that the yield curve steepened as the longer-term rate moved considerably higher. This resulted in a significant downward repricing of long-term bonds to yield interest rates close to 5% in the case of US 10-year treasuries, which stands at a multi-decade high. So now why does this matter? The rise in market interest rates had a significant impact on both fixed income as well as equity, as higher interest rates means that the present value of future earnings and cash flow is much lower. Likewise, growth companies, which is sensitive to the movement in interest rates, were more significantly impacted as well. Market participants have been keeping a close eye on economic data and central bank messaging for signs of how long interest rates will remain as high as they are now. The job and payroll data has continued to be strong, suggesting that inflation could persist over a longer period, which means the prospect of lowering interest rates anytime soon is off the table. While the US does not show any signs of recession, market participants believe that interest rates cannot continue to rise without eventually inflicting some damage to the households. Meanwhile, in Europe, there are signs of a slowdown, but not necessarily indicate a contraction. Over in Asia, China economy is starting to pick up steam again, and at the same time, the government is considering ways to open its stock market up to more foreign investment. So to sum it up, the overall picture of the global economy seems to remain healthy, and the recent pullback in the market is primarily due to the movement in the interest rates. As a result, we believe that the recent dip in markets present a good buying opportunity for investors on the sidelines, both for equities as well as sukuks. Higher discount rates both in the short term and the long term means that equities and sukuks offer better value than they did before, and this could translate into better long-term returns. So that's all from us. Thank you so much for watching this episode of Wahed Wealth Digest. Don't forget to like, share and subscribe. See you next time. Assalamualaikum.